Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, July 8th, 2020. We had a bit of a strange opening this morning. We sold off a bit in the afternoon yesterday, as you probably know by now. There wasn't necessarily a major catalyst for it, except other than that the markets had been up several days in a row, and markets don't always go up every day. So there was a little bit of normal profit taking. What was strange about this morning, though, is overnight we saw flattish futures, some vague attempts at a rally, some vague attempts at a sell-off. But then all of a sudden, when we opened up, we shot up 20 points, which is a bit, I'm talking S&Ps, shot up 20 points on the S&Ps or more, and wasn't really obvious why. And as I'm taping this now, they've essentially given back all their gains because I didn't really know why they were there in the first place. And so we're seeing a bit of that now. We'll see where the day goes. Right now, the two stories that I want to focus on more are actually more intertwined than people might realize. First of all is gold continues its rally, and you've seen all kinds of headlines, I'm sure, particularly if you do invest or trade gold, about how gold is, up above $1,800 an ounce in U.S. dollar terms. It is rallying and potentially breaking out, and it's an interesting conundrum here. Part of the reason for the rally in gold, for the strength in gold that we've seen is what I'm going to call the why not trade. One of the knocks on gold always has been that it is a non-yielding asset. Well, guess what? Fixed income is a non-yielding asset too in most of the world. And so that's why I say, well, why not? Because there's really no opportunity cost at the moment to owning gold. Yes, there are always some costs in owning it, but essentially, back in the old days, I remember there was a fund that used to be the Gold and Governments Fund, and they would sort of move in and out between gold and government bonds when the interest rate differential would change. That seems quaint by now, but that mentality still persists. The opportunity cost of owning gold, the cost that the income that you're foregoing by putting your money into a non-yielding asset, whether it's gold, whether it's silver, those definitely that makes gold more attractive on a relative basis. But you can't eat relative performance. So let's think about it on an absolute basis. Gold is sort of considered the classic inflation hedge, and while I don't necessarily see a lot of inflation on the horizon, it's not clear that it's here imminently, especially with the economic situation being still so up in the air. The other way to think about it is I prefer to think of it as the anti-dollar. It is, or anti-currency, whatever currency you're owning, it's sort of the anti-government issued currency. And that is why I think you're seeing a lot of institutional money flow in there. There are some very big calls out there from some very prominent economists and analysts. I think of Steve Roach, whom I know, calling for more or less a cataclysm in the dollar based on all the debt that has to be issued by the U.S. government. I don't necessarily go that far, but you can sort of make a case. Well, this would be the hedge, right? If you think that the government debt that's being issued will put pressure on the U.S. dollar, you might as well buy something that hedges you against the U.S. dollar in a very broad sense, and especially if it doesn't cost you very much or anything to carry, or you're not foregoing any interest. Well, then that's your trade, and that is part of it. The element that's interesting today, and you always, when you see something happen, you want to think, well, why today? And there was talk overnight about the U.S. dollar, the U.S. government trying to interfere in the Hong Kong dollar peg. And that's more threat, I think, than actual, that's more bluster right now than practical. But one of the most curious things in the financial markets to me has always been the Hong Kong dollar peg. It's essentially, to me, one of the great one-way trades of all time. The Hong Kong dollar has been pegged to the U.S. dollar at around 7.75, give or take, for years, for decades. It's been incredibly stable. And it's had a fairly unique set of economic circumstances to allow that. Essentially it's because of Hong Kong's prosperity. But to me, it's a one-way trade because it's unlikely that the Hong Kong dollar would ever appreciate materially against the US dollar, but there's always sort of that back of the mind risk that the peg could be broken. And when you start to hear, US secretaries talking about breaking that peg, it has to make you question it. And so that would be the sort of thought I would have to expect, that there would be demand coming from Hong Kong when you hear talk like that. Why would that be? Because gold is typically priced in US dollars. Essentially, Hong Kong dollars and US dollars have been essentially fungible. They've traded at pretty much a fixed ratio for decades. Well, if you think that if you own Hong Kong dollars or you're based in Hong Kong dollars, it's a way to hedge that risk. Because if the peg breaks, well, then you own an asset that's valued in US dollars, and you have that asset will appreciate in local currency terms. Is it something that I see as a huge risk that's imminent? No. But I think that's what I'm talking about here are longer term trends that are in motion and that don't really have a reason to break right now. You can argue it's gold is very high, but basically there is no fundamental price for gold. There's no price earnings ratio on gold. There's no price to sales on gold. It is what you think it's worth, and it's commodities are almost more pure supply and demand. So putting these factors into play, I think that gold just got another positive behind it, and I think that's why you're seeing some more incremental performance on the upside today. Have a good one, everybody. Bye-bye.